You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo.
Welcome back to the Reinvest Podcast. It's good to be back another week in the studio and bringing you some more great real estate content. So, as you can see, my co-host Garrett is gone. He is on paternity leave. So they had another baby. And for all those wondering, he has 7 kids. So just let that rattle around in your brain here for this next little while. And just most people can't understand 2 or 3 kids, let alone 7. So props to him. They're awesome. I don't know if I'll go to break his record or not, but there's no harm in trying. So, but today we're going to be joined by a great guest, Jason. Jason, please, I don't want to butcher your last name. What's your last name?
Melillo.
Melillo. Okay, so my name also ends in LLO, Ciminillo. So maybe, are you Italian descent, or where does that come from?
Yeah.
Okay, same here. Okay, awesome. Well, it's great to have Jason on the podcast today. And Jason, why don't we just jump right into it? Why don't you tell us who you are, what company you're with, and how did you even get into this real estate realm?
Sure. Well, first of all, thanks for having me. It's a pleasure to be here today. I am the CEO of KBKG. KBKG is a specialty tax firm that has a heavy focus on real estate incentives for real estate investors. We actually work with thousands of CPAs and their clients across the country. So that's our business. I'm the CEO of that business. Happen to have a background. I'm a CPA. So spent my career in tax and helping people, particularly business owners and real estate investors, optimize tax so that they don't be affected by that tax drag.
Yeah, and so your firm, essentially would connect with a business owner's existing CPA and kind of, counsel them through or consult through some of those tax incentives?
We do tax projects like cost segregation, and I can talk a little bit about that. But we're not doing people's tax returns for them.
Right.
We're helping them to maximize their depreciation deduction on their real property.
So you guys are kind of like the tax strategists that then work with the CPAs to be the most effective.
Yeah. Actually, we do those projects to help them get those maximum deductions. So, yeah, I'll tell you how I got started though, because I think that's the thing. After working with hundreds and hundreds of people that are real estate investors and seeing how they all got wealthy, it was through real estate, and it's really getting rich slow, right? That's I think people have an expectation that you hear those stories about, you can put no money down and invest in real estate and you'll be wealthy in no time. And when I was right out of college is when I bought my first property. It was a property I lived in, but I saved while I was in college. I worked through college. I saved money for a down payment. I spent the first year after college living at home so I could build up and save a down payment. I was able to make that down payment, and I bought a little 3-bedroom condo. I had 2 friends from college that had good jobs and needed a place to live. So I rented out rooms to them. I had roommates.
You were house hacking before it was cool.
They paid my mortgage for me.
Yeah.
So I was able to continue saving. And in 5 months, I sold that first place. And I thought I was a genius because I more than doubled my equity in 5 months. And I thought, this is easy, right? So then I doubled the size of the house, the second property that I bought. And again, thinking that I was just this smart and savvy real estate investor. And lo and behold, we hit a pretty deep recession. And, within a year or two, I had 60%, the value of my property was worth 60% of what I owed on it. So I was completely upside down. And, again, you learn in real estate that it's time. Time is what adds value and builds equity. So I took that opportunity to fix that place up over time, just the same way I did the first one. Flipping wasn't a thing when I did this. It was just like, if you fix something up, you add value to it. It's got to be worth something more. And so I did that with my second property. And again, I lived in that property and eventually doubled probably tripled my equity there, and went on to the next property.
How many years did that take? I mean, because
so
the recession that you hit was what, 2008, 9? When did you buy your property?
This was before that, but it was a 10-year window after,
10-year window. Okay.
To get back to where I was below water after a year and a half. And then, the recovery took about 5 years. And then, just by the market improving, and this is in the Southern California real estate market, which was hit really hard right before 2000. So
gotcha.
Anyway, that was kind of my initial journey. And then from there, I've bought another home and then rebuilt that and have built equity over time. And I think that's the thing to just tell people is when you invest in real estate, you have to start somewhere. And most people are starting with nothing or starting small. So figure out how to make it work for you. And whether you take that equity and then you borrow on that equity to improve it and then sell it, or to improve it, or to take the cash and buy another property that's a rental property. I like people who invest in maybe a duplex, live in one, rent out the other.
Yep.
Right.
That's what I did for my first property.
Yeah. It's possible to do. It's just a lot of people don't know how to get started. So once you get started, then you can build up and add value and grow your portfolio from there.
I like the idea of getting rich slow, because I think social media and all the other influencers that are out there and, maybe mean well, but it kind of has this like, hey, you can do it quick and fast and it's only going to take you 3 years or 2 years and you're going to be financially free through real estate. And sure, that can happen, but I would say that's the minority, not the majority. And so we had a podcast, I forget which one it was, but we had just spent the whole podcast basically talking about it's not timing the market. If you miss this last 5 years with COVID and all this crazy appreciation that everyone caught, it doesn't mean you've missed out on real estate. It's time in the market. The reason that people were so successful during that period is because they were already in the market. They already had assets and they already had investments, and the market rewarded them as it appreciated over these last 5 years. So, no, that's a great point. So you started in real estate out of college. Over time, you've just been kind of building your own real estate portfolio, or maybe even rolling equity over into more, personal residences and all this stuff.
Yep.
So how did you get into the real estate tax side of things?
So, I was a CPA working with business owners, and the first thing I noticed about business owners is when they have cash flow, they've got to do something with that cash flow if they're making money. So, there's things you could do. You can go out and buy second homes, or you could buy, a boat, or you could put money in the stock market. But what most people who are disciplined and good business owners do is the first thing they look at is if they're paying rent for their business, maybe they buy a property that they can put their business in. If they're manufacturing business, they're buying a plant so that they can put their manufacturing business in it. Maybe they're a dentist. They buy the dental office. They buy the property because now they're letting their business build equity for them by owning the real estate. Mm-hmm. And, the way that this works the best is if you're creating depreciation deductions, and, what people who have invested in investment real estate, passive income real estate understand is that they get to expense the value of that property over time. It's called the depreciation. And that depreciation shelters cash flow. It can, if you're a business owner, create surplus deductions that they can use to offset their income from their business. This is how we win at the tax game, because we reduce that tax drag. And so if we're investing in real estate, we want to pay the least amount of taxes as possible so that we can use that cash flow to reinvest in, guess what, more real estate, right?
And we're going to be talking about depreciation a lot, I think, today. And so why don't you break down for maybe a newbie, what is depreciation? Because that might be a term that flies over the head.
You bet. So all depreciation is the value of your property that is not land. So if you buy a property for $100,000 or $1 million, some portion of that property goes to land and the rest of it goes to the building. So if 10% of it goes to land and the 90% goes to building. That 90% we get to expense over time. That's called depreciation. And we get to expense that on income property. You can't do it with your personal residence unless your residence is partially income property, but you get to expense that against the rent that you collect. So if you collect $10,000 of rent and you have $10,000 of depreciation, your taxable income is zero, but your cash flow is 10,000.
Right.
Now,
It's
you may have to pay a mortgage with it, but
right.
Yeah,
it's a phantom expense. I mean, it's written off on your tax return, so your CPA would be really in tune with it, but it's not actually losing $10,000, but basically the government has written this into the tax code to basically give you credit for your property's getting older. Over time, it's going to wear down. Over time, it's going to be less valuable. And so you're able to essentially deduct that, from your income.
Exactly. That's how it works. And certainly we all know that over time, the real estate really doesn't get less valuable,
right.
But the building might have to be replaced over time. And so that's what depreciation is supposed to account for. And that the tax laws are super favorable to real estate investors. I don't know whether it's the tax lobby for real estate is that good, or if it's just that they understand that real estate is such an important part of our economy and part of our history. But it is really favorable for the real estate investor. And if you're really good at it, you can go your whole life as a real estate investor without ever paying any tax.
Which is the goal. I would like to get to that point myself personally. So working in that direction. So you'd mentioned something in passing. So you got into tax, being a CPA, working with business owners, realized that real estate is, really powerful for business owners or people making a lot of money. Talk about, when did you start KBKG? When did you transfer into that piece of the pie of kind of doing more tax strategy and being really real estate specific?
So in the late 90s, there was a court case that was favorable to real estate that kind of made this term cost segregation, which is, think of depreciation on steroids. That's what cost segregation does. It made that particular aspect of depreciation accessible to people outside of the Fortune 500. This court case kind of opened it up, and the IRS finally said, okay, we understand that what cost segregation does, it accelerates depreciation. It allows us to take that building and break it into smaller components that are depreciated faster. A commercial property gets depreciated under statute over 39 years. A residential rental property under statute gets depreciated over 27 and a half years. So if you do a cost seg study, you can break that property down into smaller pieces that get depreciated over 5 years, 7 years, 15 years, and then 27 or 39. So it's to your advantage if you're getting real estate income to carve that up into pieces. So we discovered this in the late 90s, and we said, you know what? We've got a lot of business owners that own real estate. We've got a lot of clients that are real estate investors. We need to be in this business. And we thought this would be a great way to go after new business. And the first thing we discovered is that a lot of people just didn't understand this, didn't know what it was. So we started educating people. So we started traveling around the country, just doing seminars and teaching people about what this does, teaching CPAs about what it is. And a lot of those CPAs then said, this is great. Can you help my clients with this? That's how we started KBKG, was really to work with those CPAs that needed help servicing their clients to get this depreciation deduction. And then, the webcast was invented, and then it was national. It just
took off.
Yeah.
Okay. So even myself, I didn't have a real good grasp about the power of depreciation or accelerating depreciation until we had bought our mobile home park. And so we'd bought a mobile home park, and we had to accelerate the depreciation the first year. And we ended up, accelerating like $1 million of depreciation in year one. And so ended up making a huge impact on even my income. And I wouldn't consider myself like a high income earner, but it was that powerful that I was like, wow, okay, I can see how for someone that's even earning more or higher income earner, how you can really start to cancel out some of your income and save a lot of money on taxes. And so, why don't you give us kind of the lowdown on bonus depreciation? So there was 100% bonus depreciation, and then it was sunsetting, but just recently, is it back to 100% bonus depreciation right now?
Yes.
Why don't you explain what that means?
Yeah. So the big beautiful bill that passed and was signed by the president July 4th, that brings bonus back to 100%. And what bonus does is it allows you to expense depreciation in year one, 100%. So real estate, the building can't be expensed under bonus depreciation if it's 27-year property or 39-year property. But the components of the building that you identify in a cost segregation study, those absolutely can be expensed in year one. If it's 5-year property, that 5-year property gets bonus depreciation. So if you buy something for $1 million and 10% of it is 5-year property, that 5-year property gets expensed in year one. So all of a sudden there's $100,000 deduction. Mm-hmm. Now, for someone who qualifies as a real estate professional, and we can talk about what that means and how that works, they can offset any income. So you may have a husband and wife, and maybe the wife is a real estate professional, the husband's a doctor, or does something else, has a W-2. If they own a property and they get bonus depreciation, they can use a loss from that real property against the husband's income because the wife is a real estate professional. So in your case, if there's a $1 million deduction, they could wipe out their income for the year for tax purposes, even though they had cash flow coming in.
Yeah. That
depreciation, that makes it that much powerful. So, if they save, the maximum federal rate is 37%, and then let's say they have another 5%, 42% on $1 million, there's $420,000 of cash flow that they got from that bonus depreciation deduction. And they could use that to buy another rental property.
Right.
And then they can do a cost seg on that rental property and do it again the next year.
And that's been one of the really powerful things, about me being, a real estate professional designation with, I'm a realtor full time. And then I'm also growing into this investor role and with Reinvest Capital, and we have some assets that we're managing. So it's been kind of cool to see how that plays over into my active income on the commission side of things. Mm-hmm. And so for those out there that are listening, if you're not a real estate professional and you have that bonus depreciation, what are you able to write off? Is it just from the passive gains? You can just write off the passive gains, essentially. It doesn't move over into your active W-2 income?
That's right. So you can offset your passive income. So if you can get to zero, right? If you own an apartment and you're collecting, $20,000 of rent and you get that to zero, maybe the depreciation takes you below zero, but you can't, you just carry forward the below zero part. So you have $20,000 of cash flow and no tax on that. But in your example, if you're a broker or in real estate, but what if you're not? What if you're just a real estate investor and maybe you have some other things that you do to make money or something, but as a real estate investor, you can qualify as a real estate professional if you can demonstrate that you work 750 hours or more in real estate and that you're not spending more than 50% of your time doing something else. So if more than 50% of your time is in real estate and you meet that 750 hours rule, now you're a real estate professional. And as a real estate professional, you can offset your real estate losses against any other income. And that is very powerful.
Yeah, that's powerful. And how have you seen people document that? So let's say someone is in that scenario, they're not working, in real estate full time. What's your advice for someone?
I would say keep a log, keep your calendar. There's apps that you can track things and you do something contemporaneous, like as you go. Mm-hmm. You don't want to get to an audit, then have to, after the fact, recreate things.
Right.
But for somebody, especially if you've got, a married couple and you're investing in real estate, one of those two people are spending time making sure that things are taken care of at the property, following up on, repairs and maintenance and things like that. Track your time. If you can make sure that you qualify as a real estate professional, one of the two of you, fantastic. Because now if the other one's, let's say a breadwinner that's making money, that's creating the income to help buy the real estate, now you've got a really nice synergy happening where you're able to eliminate tax on the earned income.
Yeah, no, absolutely. So what types of property, can you do a cost segregation on? So, mobile home parks, I know
Absolutely.
there's a lot more that you can depreciate from a mobile home park because it's, all the homes on it really aren't real estate. So, there's some benefit there. Infrastructure, you can depreciate.
Yeah,
what other types of properties?
So apartment buildings, commercial properties of any kind, right? So it could be from an office building to a stadium, it's golf courses, but also apartments, medical buildings, retail buildings, restaurants, anything like that.
What about a vacation rental?
Sure. So we can talk a little bit about that. We actually, recognized about 10 years ago, there was a segment of the market that was not being served because, the cost of a cost segregation study, requires an engineer to look at things. And so there's a cost factor to it. And if the property wasn't big enough, if someone didn't have maybe $1 million in basis in the property, then they weren't able to really do a study because they weren't able to generate enough benefit to make it worth their while. So we said, this whole segment of the market, people who invest in single family residences, maybe that have portfolios of properties. So we developed a software tool called a residential cost segregation tool. And that is, inexpensive. It will do the same thing as an engineered cost seg study. So you can do it on a single family residence. You can do it on a duplex, a triplex, up to 6 units. For about $900, you can have that cost seg study on a single family residence or, like a vacation property. And the vacation property, there's some special rules in order to qualify for deductions. We got to be careful there about not to spend too much time in that property.
What's the rule? What's the rule on that? Is it
so
occupancy?
It's technically 14 days or 10% of your rental days.
Okay.
So if you're renting it, 100 days a year, then you don't want to be staying in there more than 10.
Gotcha.
Now, if you're doing some maintenance and stuff like that, that doesn't really count as a usage day because you're there to do repairs and whatnot. But
so there's some loose guidelines. It gets kind of gray when you talk about some of that stuff, but that's the general guidelines if you were trying to, do it correctly.
Yeah. Now, the interesting thing about a property like that is if you're renting it on, VRBO or Airbnb and your average rental days are 7 days or less, the number of per renter. So if you have 100 days and 10 renters, that's 10 days average, right? Yeah. But if you had 20 renters, that's 5 days average. You'd be below that threshold. That makes it not a rental property, but a trader business. And if it's a trader business, now you don't have to worry about the real estate professional rule. You can look at, are you materially participating? Material participation could be 100 hours. And if you spend 100 hours managing that short-term rental that you have on VRBO or Airbnb or whatever, now you can take those losses against ordinary income. So there's kind of a slick way to benefit from, just the way the rules are set up for what is a trader business versus a rental property.
So you had mentioned that for as little as $900 now you can get a cost seg on a single family residence. At what point would it not quite make sense? There's a lot of rentals maybe in our area in the Midwest where you're maybe sub $100,000 for a rental.
Right.
At that point, does it seem like it's probably not worth it to go ahead and spend $1,000 or
yeah,
what have you seen?
So one of the things that, what cost segregation does is it depreciates the building faster. It doesn't create more depreciation, right? If you have $100,000 of depreciation, you're getting 100,000 of depreciation just over a shorter period of time. So it's really a time value of money.
Yeah.
So we do a net present value analysis before anyone does a project just to say, well, here's the net present value benefit if you do the study versus not doing the study. And as long as that NPV number is greater than what you would spend, now, you don't want to do it if the NPV is exactly what you'd spend, there's probably not a reason to do it.
Right.
We like to look at, is it 10 times the number? Yeah, that's pretty good. That makes a lot of sense.
Yeah.
So, um, it's just a business decision that you make based on the information. Anyone that does this will give you a proposal ahead of time of what that looks like before you're committed to anything.
Which is good to know. So, I mean, for everybody listening, I mean, if you are in that stage where you're buying properties or upscaling properties, might be worth looking into, especially, we have 100% bonus depreciation right now. So if you're planning on rolling, things forward and trying to recycle your capital faster, and like you said, it's the time value of money. If you're planning on continuing to push your real estate portfolio forward, probably a good thing to at least look into, get a quote on, and really figure out if it's the right thing for you right now. Can you walk us through kind of a case study? I mean, do you have any examples of like clients where this has really benefited them, and kind of how did that shape out dollars and cents?
Okay. So many examples, but this one I like. When someone has an existing real estate portfolio and they haven't done cost segregation, they can do it, and there's a catch-up effect. In other words, if I could have depreciated $1 million and I only depreciated 100,000, that $900,000 difference that I'm catching up, I can take it in 1 year. So when you have somebody who has a large taxable event, maybe they sold a property and they thought they were going to have to pay tax on the sale, and you see that they've got other properties, and let's say that they sold a property in 2024 and they had a gain of $1 million that they were going to report. And they've got other real estate property that they own. And we do that exercise and we say, yeah, you know what? If we were going to do a cost seg study on these other properties that you own, there's $1 million catch-up effect. We can actually do that before they file. If they've extended their tax return, we can do it retroactively and take that deduction on their 24 return and wipe out that $1 million gain. Wow. So they thought they were going to have to pay tax on $1 million. Maybe they've already even paid the tax on $1 million. Now they're getting a refund because they do the cost seg study. They say, oh, I didn't know I could have taken more depreciation. They take that expense on their tax return with their CPA, wipe out that gain, and put the money in their pocket.
Yeah, all of a sudden they're ready to buy another property.
Yeah. So, sometimes that happens where someone's doing an exchange. They took some cash out of the exchange that created a taxable event, and they want to, figure out like, what can I do about that? If they've not done the cost seg study on other properties, that's a great case study for doing it after the fact and getting a benefit when you thought you were cooked.
Yeah. Especially when you're talking about if they had been rolling forward money from like a 1031 exchange for a while, there could be a lot of deferred taxes that would be owed.
That's right.
At the point of a sale. So having cost segregations in an existing portfolio in your back pocket to help wipe out some of that or ease the pain of that a little bit is actually a really good thought and strategy. I had not thought of that before, as it relates to like people at some point maybe needing to use some of that capital outside of a 1031 exchange. So that's pretty interesting. Are there any misconceptions or mistakes when it comes to cost segregations that you've seen as you've been helping business owners do this and CPAs do this that people need to be looking out for?
Yeah, the one thing to be careful about is if you're a passive real estate investor and you've got passive income, if you're in a passive loss situation, you got $100,000 of passive losses and you're still not taxable on your real estate property, a cost seg isn't going to do you any benefit at that time. Maybe in the future it will, but don't do it then. Wait until you've got positive taxable income. And so sometimes that's something where someone who's inexperienced, or they talk to the wrong person, they're not getting good advice, they could do a study when they don't need to. So if you're taxable, then it's always going to be a value benefit to you, because the idea is to wipe out taxable income. And, if someone thinks that they're going to be able to use their passive losses to offset active losses,
right.
Well, we've already kind of talked about how you got to do that. And so just, I would say, be careful there.
Yeah. Sometimes it's a good idea. It's just a not yet idea.
Exactly.
So, okay, let's jump into our smaller pocket segment. So, Jason, tell us about a real estate deal that has gone wrong. It could have been one that you did personally. It could have been maybe something that you helped a client through. So what went wrong, and what did you learn from it?
Well, I think I kind of alluded to it early on in our discussion. My second property, where I thought I was a genius after 5 months and doubling my equity, and then basically doubling down on a much bigger property, and thinking, oh, within a year or two I'll be able to sell this one and go on to the next one, and that was my plan.
Right.
But timing is everything, right? And so the lesson I learned there is real estate is not a short-term game.
Yeah.
It's a long game, and you have to be patient as an investor, and take your time.
Yeah, no, that's good. It's good advice. Hard to do. I think everybody has that natural reaction to want to move fast and far and get things done and see that build quickly. But I mean, you look at everybody that's been in the game for a while, and they'll all say the same thing. I mean, it's cycles. Everybody goes through cycles. Everybody's portfolios go through cycles, and it's the time in the market, not timing the market. So, all right, we're going to jump into our little nugget. So what's one practical takeaway or piece of advice that our listeners can implement into their investing business or their business?
Well, I heard you talk about, on a recent podcast, you talked a little bit about EOS. That's something that we use within our business. I think it's great from an alignment point of view, making sure that anyone in your business understands what are your goals, what are your long-term goals. Not anyone, everyone in your business understands your long-term goals. So, if you're an investor and you're the only one in your business, maybe it's not as much of a nugget, but it is planning for long-term goals and having the short-term goals that help you to get to the long-term goals. So I still think that's applicable even to a single real estate investor. You may say, hey, by 10 years from now, I want to have enough income from my rental properties to support my lifestyle. Then you have to just back into, between 10 years from now and now, what is it going to take to get you there, and see, is that even realistic? Is it even possible? What kind of returns would have to happen? How much would the market have to go up based on the real estate you own now? What would have to happen to interest rates? So I think that entrepreneur's operating system is really helpful to planning for your outcomes.
And what I've loved about that is that, I think a lot of people maybe are like, we'll do our year in review, so they're kind of going from year to year. They're reviewing, did last year work? And one thing I've liked about EOS, it's quarterly. I mean, so not only weekly are you checking in, but how EOS is designed is, every quarter you're looking at your goals. Okay, are the goals that we have in front of us for this quarter going to get us closer to our 1 year goal, which is then based upon the 3 and the 10-year goal.
Right.
And so it's always kind of that forward looking. And if you are just reviewing once a year, you've wasted a lot of time. But if you can review quarterly and you can make those micro adjustments or maybe shift some goals quarterly, you're going to get to your goals a lot faster, and you're going to stay on track instead of like spinning your wheels for a year and realizing, oh, what we started wasn't actually working. And so what have been some of the most helpful tools in EOS? I know for people listening, maybe you're not super familiar, but look it up. There's a book called Traction that really breaks down what EOS is, that you can go, buy or listen to. But for you guys, what's been some of the best tools from the EOS system that you've used for your business?
Well, the weekly scorecard for sure. We've got 160 or 170 employees, and they're all doing different things. And what the book Traction talks about is everyone has a number, right? So they're all doing something. They're all responsible for something, and each group within our company rolls up into their own scorecard so that we can monitor what's going on. Are they hitting their numbers or they're not? And what all that really means is you're looking at leading indicators. You don't wait for a result to happen. You look at what does it take to get to that result, and are you doing the things that you need to do to get to your result? And if you are, great. If you're not, what do you need to change? Or if you're doing the things that you think you need to do and it's still not getting your result, then you need to look at a different metric.
Yes, exactly. Yeah, that's honestly been the best thing for us. It's kind of like when you're starting out, I mean, for anybody that's maybe a smaller business starting out, it's like, what are we supposed to track? And is what we're tracking actually the right things to track? And so this last 12 months as we've been in this, we've adjusted our scorecard or added things to our scorecard to be like, okay, here are some of the metrics that we need to dial in and keep a better pulse on. And it's been really interesting to see how that's impacted our business even this year. So no, thank you for sharing that. Like I said, if you guys are interested in that, if you're a solopreneur, it's not super applicable right now, but there's still a lot of great principles in that book. So, but if you have a small business, definitely check out EOS and see how it can, how you can implement into your business. So in closing here, what has been one of the best resources aside from EOS for your business development? Could be a book or podcast or person.
Yeah. I think, for business development, I think really just understanding and it really is still back to EOS and just making sure everyone understands and is aligned around what we're trying to accomplish, so that everything anyone is doing is specifically supporting the end result we're expecting.
Yeah. There's a sign up in the office, and it was I forget what that. It's like a rowing team, but it was kind of like, we all got to be rowing in the same direction. And if someone's not in sync with everybody else, it's going to affect the whole boat. And I love the kind of the imagery of that, of, hey, we got to be rowing in the same direction. If someone's rowing a different direction, we're going to turn the wrong way. And I just love that symbolism. And so that's exactly right. It kind of keeps everybody on the same pulse.
I will say the other thing is the right person in the right seat.
Yeah.
If you have somebody who's not, they're just not good at what you need them to be doing, maybe they're in the wrong seat, or maybe they just don't belong at your company. And, I think a lot of small businesses, that's one of the mistakes they make, is they carry somebody too long because, well, they've got that relationship with them, and we don't want to hurt their feelings. But, at the end of the day, they're taking a spot that somebody that could be much better and more productive and helpful to the business. And maybe they're in the wrong place for them anyway. And so, free them up to go find what's right for them.
Yeah, it's almost not fair for anybody to keep them there, because they're probably not feeling like they're excelling, because they're not. And you're making everyone else in your company essentially, suffer some consequences for that wrong person in the wrong seat. So, but that is tough. So, okay, how can people find out more about you and your company, and maybe follow along with your success, or maybe reach out about a cost segregation?
Sure. KBKG.com. That's our website. We have lots of information, articles. All of our resources are on there. So we have software tools on there. The residential cost segregator is on there. So I recommend, if you're a real estate investor, go check it out. You can connect with me at Jason Ciminillo on LinkedIn. Love to hear from you.
Awesome. Well, I appreciate your time today and sharing with us about cost segregations and some tax strategies for business owners and real estate investors alike. It was really insightful.
Great. Thanks for having me.
As always, excited that you joined us for another episode of the Reinvest Podcast. If you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, reinvestcapital.us, and shoot us a message. Move farther, reach higher, and grow deeper.